Finance News Update, top financial stories for today. Disclaimer, the following content is presented for news and information. While the tech-heavy Nasdaq jumped 1.71% to 26,247, both reaching fresh all-time peaks. A better-than-expected U.S. jobs report in April, along with robust corporate earnings from tech giants, bolstered investor confidence and helped markets extend a multi-week winning streak. Asian markets also notched strong gains on hopes of de-escalation in the Middle East conflict, with Japan's Nikkei index spiking nearly 6% on optimism about a possible U.S. Iran peace deal. The broad rally comes even as investors remain mindful of risks from elevated oil prices and unsettled geopolitical tensions, which have tempered gains in some sectors. Overall, global equities are demonstrating resilience, lifted by economic data and tech momentum, yet tempered by caution over how long current optimism can withstand persistent geopolitical uncertainties. Asian and European equities have mirrored the bullish sentiment seen on Wall Street. In Hong Kong and Tokyo, stock benchmarks climbed to their highest levels in years, aided by strong corporate results and the promise of technological innovation driving growth. Hopes for a ceasefire in the prolonged Middle East conflict also helped buoy sentiment late in the week by easing fears of a deeper economic shock. Europe's exchanges saw more moderate but positive movement. A pause in rate hikes by the European Central Bank combined with easing energy prices provided a stable backdrop for continental markets to advance. However, trading volumes suggest some investors are hedging their bets, wary that any setback in peace negotiations or unexpected economic data could quickly reverse these gains. Still, the prevailing mood across global trading floors today is one of cautious optimism, with market breadth and risk appetite considerably stronger than earlier in the year. Despite the current uptrend, analysts warn that stock valuations are stretched and could be vulnerable if conditions change suddenly. The rally has been fueled largely by expectations of future growth from major technology companies, prompting some to worry that markets may be pricing in perfection. Observers note that a handful of mega-cap stocks are disproportionately driving indices higher, a dynamic that could leave indexes exposed if investor sentiment shifts. There is also recognition that sustained high oil prices due to geopolitical tensions and persistent inflation might eventually test corporate margins and consumer spending. Market strategists emphasize that while the bull run is intact for now, maintaining discipline is key as volatility could resurface if economic data disappoints or global risks escalate. They underscore that even in a bullish environment, prudent risk management remains important in the face of potential headwinds. Subtopic: Tech bubble concerns surface. Some veteran investors and market strategists are expressing concern that the current tech-led surge is showing signs of a speculative bubble. Famed investor Michael Burry, known for predicting the 2008 financial crisis, recently warned that the stock market's fixation on artificial intelligence stocks and other high flyers is reminiscent of the late 1990s dot-com boom. Burry argued that share prices have been going straight up because they have been going straight up, a self-reinforcing momentum he likened to the final stages of the 1999 to 2000 bubble. Another portfolio manager, Keith Buchanan, noted that equity valuations are failing to adequately reflect the risk of prolonged geopolitical conflict and Two U.S. macroeconomy shows resilience but persistent inflation weighs on consumers. The U.S. economy is sending mixed signals, with a steady labor market but stubborn inflation that continues to strain household budgets. New data from April's employment report showed non-farm payrolls rising by 115,000 jobs, modestly above forecasts and indicating a still resilient jobs picture. Unemployment held at 4.3%, suggesting the labor market remains relatively tight even amid higher interest rates and global uncertainty. At the same time, wage gains have moderated and overall economic growth is decelerating compared to last year's rapid pace. There are signs that the economy is maintaining momentum without overheating, but economists caution that a slower, steady expansion may lie ahead as consumers and businesses adjust to higher borrowing costs. The backdrop is one of gradual cooling, not a downturn, but an economy settling into a more sustainable post-pandemic growth rate. Inflation, however, remains above target and a source of concern. Price pressures eased from the peaks of late 2022, but the latest consumer price index shows inflation running at roughly 3.3% annually, still well above the Federal Reserve's 2% goal. Energy costs have been volatile due to geopolitical events, and core inflation in services remains elevated, keeping up the cost of living for many Americans. Businesses continue to face higher input expenses, some of which are passed along to consumers in the form of pricier goods and services. The combination of sticky inflation and moderate wage growth means many households are seeing their purchasing power eroded. Economists warn that inflation's slow retreat could delay any future interest rate cuts, or even prompt further hikes, as policymakers remain vigilant to ensure price stability. American consumers are feeling the pressure in their day-to-day finances as high prices persist. The University of Michigan's Consumer Sentiment Index fell to a preliminary reading of 48.2 in May, near its lowest level in decades. According to survey analysts, households cite elevated food, fuel, and housing costs as key sources of financial strain, weighing on confidence in personal finances. Retail spending overall has not collapsed. In fact, higher-income consumers continue to spend robustly, but many families are trimming non-essential purchases and dipping into savings to cope with rising living expenses. This divergence reflects a K-shaped economic trend, with wealthier households faring better while lower-income groups struggle to keep up with inflation. If price pressures ease later in the year, sentiment could recover, but for now consumers remain cautious, focusing on necessities and bracing for the possibility of tougher times ahead. 3. Monetary policy, Fed signals extended rate pause amid inflation concerns. Federal Reserve officials are sending a clear message that interest rates are likely to remain higher for longer as inflation proves more persistent than hoped. At this week's meeting, the Fed kept its benchmark policy rate unchanged and indicated it is in no rush to start cutting rates. A cooling but steady labor market, April's modest 115,000 job gain, suggests there is no urgency to stimulate employment, while price growth remains above comfort levels. Fed policymakers noted in their post-meeting communications that the fight against inflation is not yet won. Recent data show core consumer prices stuck over 3% annually, and the central bank's 2% target remains a distant goal. As a result, officials are leaning toward a hawkish stance, keeping rates at their current elevated levels and even contemplating further hikes if price pressures do not abate. The central bank's internal debates also reveal a shift away from earlier guidance that had hinted at future rate cuts. At least 3 regional Fed presidents dissented from any language suggesting the next move would likely be a decrease, preferring to emphasize the potential need to raise rates again if necessary. Analysts interpret this as a sign that the Federal Open Market Committee is prepared to hold rates elevated well into 2026, prioritizing its inflation-fighting credibility. Indeed, financial markets have largely priced out the possibility of rate cuts in the near term, and some futures indicators even suggest no cuts until late 2026 or beyond, absent a major economic downturn. This marks a notable change from earlier in the year, when investors widely expected easing by year's end. With supply shocks from overseas conflicts and stubborn domestic price growth, the Fed's stance underscores that taming inflation remains the top policy priority. Federal Reserve officials have also emphasized their willingness to adjust course if conditions change, but for now the bias is clearly towards caution. Chicago Fed President Austin Goolsbee noted concerns that inflation has stopped making progress in recent months and could rekindle if the central bank moves too quickly to ease policy. Fed watchers say the confirmation of a hawkish tilt means businesses and consumers should plan for higher borrowing costs to persist. This extended tight policy is expected to weigh on interest-sensitive sectors such as housing and banking, yet the Fed views it as necessary to prevent entrenched inflation. In summary, the Fed's actions and commentary this week point to a prolonged pause in rate reductions, and possibly further tightening, until clear, sustained improvement in inflation is achieved. Monetary policymakers remain on alert, poised to respond if economic data surprise, but overall see few reasons to loosen the reins on credit conditions in the immediate future. Subtopic: Fed leadership transition and policy expectations. The impending change at the helm of the Federal Reserve has added another dimension to policy expectations. President Donald Trump's nominee for the next Fed chair, Kevin Warsh, faces a challenging landscape. Warsh, a former Fed governor known to favor lower interest rates, was selected with the hope of easing monetary policy further. However, persistently elevated inflation has largely removed any justification for rate cuts in the near term. Traders now foresee little chance of a rate reduction before late 2026, reflecting how Warsh's dovish leanings may be constrained by the realities of a 3% plus inflation environment in a cautious committee composition. This dynamic could create friction, as the Trump administration has publicly pressed for rate relief to stimulate growth, but senior Fed officials remain focused on price stability above all else. Warsh's ability to steer policy toward his preference for looser monetary conditions will likely be limited unless inflation subsides markedly. As Warsh prepares to take over the central bank's leadership, analysts suggest the new chair will have to navigate a fine line between fulfilling political expectations and maintaining the Fed's credibility in controlling inflation, at least in the early part of their tenure. For banking sector stable but regulators eye new risks. U.S. banking institutions are entering the summer in a position of cautious stability, even as regulators warn of emerging vulnerabilities beneath the surface. According to the Federal Reserve's latest financial stability report, reflecting data through late April, banks overall remain well capitalized and household debts have moderated since the pandemic era. On the surface, most measures of financial health look solid, with private sector debt ratios declining and credit availability steady. However, regulators note that asset valuations across nearly every major class are stretched by historical standards, indicating that markets are priced for perfection. The worry is that with high stock prices and tight corporate bond spreads, investors have little margin for error should economic optimism falter. The report also flags the rapid growth of private credit, loans made by non-bank lenders, as a potential fault line, as less regulated lenders take on risk that is more hidden and harder to monitor. Banking officials are also increasingly focused on the interconnection between financial risks and operational challenges. The Office of the Comptroller of the Currency, OCC, released its semi-annual risk perspective highlighting how banks face elevated and interconnected threats tied not only to credit quality, but also to technology, cybersecurity, and fraud. The OCC noted that even as concerns about deposit runs and interest rate losses have eased since last year's regional bank turmoil, a broader structural shift is underway. Higher interest rates combined with rapid digitalization are testing banks' adaptability. For example, commercial real estate remains an area of focus. Rising interest rates are pressuring property loan refinancing, which could gradually erode some banks' earnings in vulnerable segments. The regulators stress that while immediate systemic dangers appear contained, the banking system's resilience will depend on how well institutions manage these evolving risks in the months ahead. So far, the banking system's fundamentals remain sound by traditional measures, but officials are not complacent. Liquidity positions have improved significantly compared to last year's turmoil, and overall capital buffers are at multi-year highs for many banks. Yet regulators caution that resilience is not the same as immunity from shocks. They point out that digital banking has made the financial system more efficient but also potentially more fragile. As seen in 2023, depositor sentiment can turn on a dime in the age of social media, accelerating the speed of withdrawals beyond what banks historically planned for. Moreover, shadow banking sectors such as hedge funds and non-bank lenders carry high leverage and less transparency, posing uncertainty if markets suddenly reprice risk. The upshot is a financial sector that appears healthy now, but one where multiple agencies are urging vigilance. They advocate proactive risk management and stress testing to ensure banks can weather scenarios ranging from credit downturns to technology failures, maintaining public trust in the system's stability. Subtopic: Rising cyber and operational threats in banking. Regulators are increasingly highlighting operational resilience as a critical focus for banks in the digital age. The OCC's report underscores that cybersecurity, fraud, and third-party technology dependencies are now viewed as core vulnerabilities, not mere technical issues. Officials warn that banks face an elevated threat environment from cyber attackers, with high levels of fraud seen across payment channels from checks to peer-to-peer apps. Meanwhile, the growing reliance on external cloud providers and fintech partnerships introduces concentration risks if critical systems fail or a key service provider faces disruption. The regulator's message is that as banks race to modernize their digital infrastructure and integrate artificial intelligence and new payment technologies, they must equally invest in risk controls to keep pace with innovation. In essence, ensuring operational resilience, the ability to prevent and withstand tech-driven shocks, is becoming as vital to the banking system's safety as capital adequacy. By emphasizing these challenges, supervisory agencies are pushing banks to fortify their defenses against emerging threats that could spark a crisis just as easily as financial mismanagement. 5. Fintech and innovation, AI and blockchain reshape financial services. The convergence of financial technology, artificial intelligence, and blockchain is spurring new services and reshaping how companies manage money. In a notable development, Lightspark, a startup led by former PayPal president David Marcus, is launching a new banking platform that acts as a go-between for businesses and AI-driven agents using stablecoins and the Bitcoin Lightning Network. This platform leverages the growing acceptance of blockchain-based stablecoins, digital currencies pegged to traditional assets like the US dollar, enabling near-instant, low-cost transactions between corporate systems and automated AI tools. By facilitating machine-to-machine financial interactions, Lightspark's solution aims to streamline operations such as payments and data exchanges in real time, reflecting how fintech firms are pushing boundaries with hybrid technologies. The adoption of AI and cryptocurrency technologies in finance is driving the industry towards radically new possibilities. Analysts point to the early emergence of zero-person companies, business entities running autonomously via algorithms, as an example of this trend. Such concepts, highlighted in recent Forbes reports, imagine organizations where artificial intelligence handles operations and decision-making, while blockchain-based smart contracts manage transactions, all with minimal human oversight. Though still largely experimental, these ideas underscore how fintech innovation is challenging traditional models. Industry observers say advances like Lightspark's platform demonstrate a broader shift. Financial services are becoming faster, more decentralized, and more automated. The blending of AI capabilities with secure digital currency networks opens the door to a future where everything from routine payments to complex financial agreements could be executed autonomously, with trust ensured by code and cryptography. As regulatory clarity catches up to these innovations, fintech pioneers continue to test the limits of what's possible in the quest for efficiency and new value creation. Fintech advances are not limited to startups. Established financial institutions are also investing heavily in digital innovation. Major banks and payment companies are incorporating AI to improve fraud detection and customer service, deploying advanced algorithms that learn from millions of transactions to flag suspicious activity or tailor financial advice. Traditional firms are partnering with or acquiring fintech startups to accelerate their adoption of blockchain for cross-border payments and supply chain finance, taking advantage of real-time settlement and security features. Meanwhile, central banks are exploring digital currencies, and regulators are working on frameworks to supervise new financial technologies without stifling their growth. The overall theme is collaboration between the tech and finance sectors. From core banking modernization to cryptocurrency integration, the financial system is evolving rapidly, signaling that the next generation of financial services will be defined by greater speed, automation, and global connectivity. 6. Corporate earnings. Tech titans beat expectations, fueling market optimism. Earnings season has delivered upbeat news from some of the world's largest companies, particularly in the technology sector. 5 mega-cap firms, Alphabet, Amazon, Apple, Qualcomm, and Caterpillar, all announced quarterly results that surpassed analysts' estimates, showcasing resilience and strong demand in diverse industries. These companies each excelled in different areas. Alphabet, Google's parent, posted its fastest revenue growth in years thanks to surging cloud computing sales. Amazon's profits rebounded on improved retail margins and cloud growth, and Qualcomm saw solid demand for its smartphone chips and automotive technology. Even Caterpillar, a bellwether for the industrial economy, reported its largest earnings beat in several quarters, buoyed by robust orders for power generators and machinery amid a boom in data centers and infrastructure spending. Together, the blockbuster results from these market leaders have reinforced investor confidence that the corporate sector can navigate inflation, higher interest rates, and global uncertainty while continuing to grow. Among the standout performers, Apple Incorporated reported record-breaking financial results that underscored the strength of big tech. For its fiscal second quarter, the first quarter of the calendar year, Apple posted revenue of $111.2 billion, a March quarter record, and net profit of $29.6 billion. The iPhone maker achieved double-digit sales growth across all its major product categories and geographic regions, with particularly strong demand for the latest iPhone 17 lineup and all-time high revenue in its services segment. In a sign of confidence, Apple's board authorized an additional $100 billion for share buybacks and raised its quarterly dividend, returning more cash to shareholders. Apple's stock saw a modest bump after the earnings announcement, reflecting investors' satisfaction with the company's continued ability to innovate and generate robust profits even in a challenging environment. The wider implications of these earnings results are positive for financial markets and the economy. The strong performance of technology and industrial giants suggests that segments of the economy are weathering challenges such as inflation and supply chain issues by capitalizing on secular trends like AI adoption and infrastructure investment. Analysts note that leading firms are separating themselves from the pack, widening the gap as they outperform expectations and invest in future growth. This has contributed to rising stock prices and a buoyant mood on Wall Street in recent weeks, with major indices climbing in response to earnings beats. However, some caution that success is not uniform across all sectors. Smaller companies and consumer-facing businesses may not be seeing the same level of growth. Nonetheless, the parade of high-profile earnings beats has reassured investors that corporate America's fundamentals remain strong, and that innovation-driven companies can thrive amid economic headwinds. Subtopic: Chip partnership spurs stock surge. In an eye-catching corporate development, Intel Corporation's stock jumped sharply this week after news of a major new deal with Apple Incorporated sparked excitement among investors. The semiconductor maker's shares rose on reports that Apple has reached an agreement to use Intel's technology in upcoming products, marking the revival of a partnership between the two tech giants. Details of the arrangement are still emerging, but it is believed to involve Apple tapping Intel's advanced chip manufacturing capabilities or components for future devices, a notable shift given Apple's recent moves to design semiconductors in-house. Market analysts say this potential collaboration could significantly boost Intel's revenue and market relevance in the high-end chip segment. The development hints at renewed opportunities for legacy chip companies to align with consumer electronics leaders as device makers seek extra capacity and expertise to meet surging demand. Intel's stock surge underscores how strategic corporate alliances, especially in critical tech supply chains, can quickly reshape investor sentiment and industry dynamics. 7 Commodities. Oil and gold prices soar on geopolitical and economic uncertainty. Global commodity markets remain on edge as oil and gold prices continue to trade at elevated levels, reflecting the impact of conflict and a flight to safety by investors. Crude oil prices are hovering near multi-year highs, with Brent crude around $100 a barrel as of today's trading. Ongoing hostilities involving Iran and regional instability in the Middle East have fueled supply concerns. The periodic closure of the vital Strait of Hormuz shipping route has choked off significant oil flows, contributing to higher prices for energy importing countries. Early hopes for a diplomatic resolution have led to some volatility. Oil pulled back on news of potential peace talks, only to rebound as fighting flared anew. Market analysts now expect oil to remain near triple-digit prices as long as uncertainties persist, given limited spare capacity globally and resilient demand. The elevated cost of crude is trickling down to consumers via higher gasoline and transport costs, adding to inflationary pressures worldwide. Gold has also surged to near-record levels in recent days, underscoring investors' desire for safe haven assets during turbulent times. Spot gold prices have climbed toward $4,700 per ounce, roughly double their pre-pandemic level, amid persistent global uncertainties and concerns about rising prices. The war in the Middle East, as well as fears of broader geopolitical conflict, have boosted demand for gold as a store of value. Additionally, speculation that central banks might slow or halt interest rate hikes due to economic risks has weakened the US dollar slightly, making dollar-priced gold more attractive to international buyers. Bullion analysts note that gold tends to rally when real interest rates are low or negative and when investors seek a hedge against currency volatility. While profit-taking can cause short-term dips, the overall upward trend for gold remains intact, with many traders expecting the metal to stay elevated as long as uncertainty and inflation anxiety persist. Other commodities are also reacting to the complex global backdrop. Industrial metals prices have been seesawing with each new development in the global economy and geopolitical sphere. For instance, copper, often seen as an economic barometer, rallied earlier this year on hopes of a robust China reopening, but its gains have moderated due to concerns that higher interest rates and war-related disruptions might dampen global growth. Agricultural commodity prices, meanwhile, show increased volatility due to unpredictable weather patterns and trade dynamics. As a whole, the commodity sector is reflecting a world balancing between recovery and risk, strong demand in some areas driving prices up, while potential supply shocks and macroeconomic headwinds inject caution. Investors and policymakers are watching commodity markets closely, as sustained high energy and raw material costs could complicate efforts to rein in inflation without derailing growth. 8. Cryptocurrency, Bitcoin nears new highs as regulatory clarity advances. Cryptocurrency markets are gaining momentum, with Bitcoin, the world's largest digital asset, trading at levels not seen in years amid broad market optimism and evolving regulatory developments. Bitcoin's price has surged past the closely watched $80,000 mark, continuing an uptrend from its early year levels to reach an 18-month high. Analysts attribute this strength to a combination of factors: increased institutional interest, global inflation concerns driving some investors toward alternative assets, and hopes for clearer crypto regulations that could unlock new investment. Market sentiment has been buoyed by a relatively calm period in crypto market volatility, as well as high-profile events like the Consensus 2026 conference in Miami highlighting growing mainstream adoption of blockchain technology. While Bitcoin's ascent has slowed slightly near the $80,000 threshold, traders remain optimistic that renewed demand and positive headlines could propel it to fresh record territories later this year. Ethereum and a number of other leading cryptocurrencies are also seeing gains, supported by improved sentiment and technical upgrades to their networks. Total crypto market capitalization has expanded, although still below its all-time peak from 2025. One recent driver for digital assets has been a weakening US dollar and expectations that central banks may moderate their tightening cycles, making non-traditional assets more appealing. Moreover, cryptocurrencies are increasingly intertwined with developments in technology and finance. For example, a surge in interest around AI-related tokens and blockchain applications has paralleled the excitement in public equity markets over artificial intelligence. However, market experts caution that crypto remains highly volatile, with sizable price swings possible due to speculative trading and shifts in regulatory outlook. Still, the broader trend over recent weeks suggests a renewed risk-on appetite in the digital asset space, coinciding with constructive news on the regulatory front. Regulators and lawmakers are moving toward providing greater clarity for the crypto industry, a development welcomed by many investors. In the United States, a bipartisan legislative effort known as the Clarity Act is gathering momentum in Congress, aiming to establish clear rules for digital assets including cryptocurrencies and stablecoins. The Senate Banking Committee is reportedly preparing to review and possibly vote on the act as early as next week, which could formalize how different digital tokens are classified and regulated by agencies like the Securities and Exchange Commission and the Commodity Futures Trading Commission. This has raised hopes that the U.S. will finally have a cohesive framework for crypto, reducing legal uncertainty that has kept some big investors on the sidelines. In parallel, regulators are working on specific stability rules for stablecoins, the digital tokens pegged to fiat currencies, to ensure they are safely integrated into the financial system. The prospect of clearer guidelines is seen as a long-term catalyst for the crypto market, reinforcing the idea that digital assets are here to stay. Industry participants are encouraged by the shift from enforcement toward constructive regulation, though many remain watchful as the legislative process unfolds. Subtopic: U.S. China Rare Earth Pact preserved. In other international finance news, a significant agreement between the United States and China in the critical minerals sector remains intact despite broader tensions. A U.S. official confirmed that an existing U.S. China rare earth trade deal is still in effect and may even be extended. The pact, originally struck in a prior bilateral negotiation, ensures ongoing cooperation in the supply of rare earth elements, vital materials used in high-tech industries such as electronics, electric vehicles, and defense. The statement about maintaining this agreement comes ahead of a planned summit between President Donald Trump and Chinese President Xi Jinping, indicating that both nations are keen to preserve certain economic linkages even as strategic competition in other areas continues. Experts view the rare earths understanding as an important confidence-building measure. It helps stabilize a key part of global supply chains and underscores how targeted diplomacy can mitigate risks in essential commodities. The continuity of the rare earth deal suggests that pragmatic economic interests can sometimes override political frictions, at least in specific domains critical to both economies. 9. Global finance. Pakistan secures funding and taps new markets amid crisis. Emerging economies are adjusting their financing strategies in response to global challenges. Pakistan this week announced plans to issue its first-ever Panda bond, a UN-denominated bond in China's capital markets, in an effort to shore up its foreign exchange reserves and diversify funding sources. The $250 million inaugural issue, part of a larger $1 billion program, is scheduled for launch next week and will be backed by the Asian Development Bank and the Asian Infrastructure Investment Bank. Pakistan's Finance Minister Muhammad Aurangzeb said the country's economy is showing signs of recovery with rising exports and remittances, but it has faced serious strain from the impact of high global energy prices and a war raging in Iran that temporarily closed the Strait of Hormuz, disrupting critical fuel supplies. The Panda bond is seen as a milestone for Pakistan to access Chinese capital and reflects deepening financial ties between Beijing and the developing world. The International Monetary Fund, IMF, has also stepped in to support Pakistan during these turbulent times. This week the IMF released about $1.32 billion in new funding to the country as part of two ongoing loan programs aimed at stabilizing Pakistan's economy. These funds come at a crucial moment, helping Pakistan bolster its foreign reserves and meet external debt obligations as it grapples with the economic fallout of energy shortages and inflation. The combination of multilateral assistance and bilateral financing, such as the Panda bond, underscores a broader trend in global finance. Emerging markets are diversifying their sources of capital. With Western interest rates high and geopolitical uncertainties complicating traditional fundraising channels, countries like Pakistan are increasingly looking to new partners and novel instruments to secure the funding needed to sustain growth and stability. Pakistan's maneuver exemplifies how global finance is evolving in response to a changing geopolitical landscape. By tapping into China's UN-denominated bond market, Pakistan is potentially reducing its reliance on US dollar funding and forging closer ties with Asia's economic powerhouse. At the same time, the backing from institutions like the ADB and AIIB indicates continuing cooperation between global and regional financial bodies to support vulnerable economies. Financial analysts say this balancing act, leveraging both traditional allies, like the IMF, and new partnerships, like Chinese markets, highlights how nations are navigating complex economic waters in the wake of worldwide disruptions. The hope is that these diversified funding approaches will provide more stability and flexibility for emerging markets. However, experts caution that such strategies also entail new risks, from currency exposure to geopolitical strings attached, meaning careful management is required to ensure that the cure does not create new vulnerabilities. Subtopic: U.S. consumer divide widens under inflation. The effects of inflation and high interest rates are being felt unevenly across different segments of the U.S. population. While overall consumer spending has been surprisingly resilient, there are clear signs of a K-shaped divergence in financial health. Higher-income households, buoyed by accumulated savings and wage gains, are largely maintaining their spending on discretionary items and travel. In contrast, many lower and middle-income families are struggling to keep up with essential expenses as prices for necessities like gasoline, groceries, and rent remain elevated. Surveys show that these households are cutting back on non-essentials and in some cases even rationing basics to stretch their budgets, a grim echo of hardship not seen since the last inflation spike. The result is an economy where retail sectors serving affluent consumers, luxury goods, high-end services, and entertainment continue to do well, while discount retailers and food banks see rising demand from those feeling the pinch. Policymakers are paying close attention to this widening inequality, recognizing that sustained cost of living pressures can exacerbate economic divides even as aggregate spending figures appear stable. The trajectory of inflation and wage growth in coming months will determine whether this gap narrows or continues to widen, influencing both economic policy and the broader social landscape. 10. Consumer finance. Households brace as costs stay high. American households are navigating a challenging financial environment marked by persistent price increases and high borrowing costs. Even though inflation has come down from its peak, everyday staples remain significantly more expensive than they were a few years ago. Families are contending with elevated grocery bills, expensive gasoline, and rising rents, forcing many to draw down savings or rely on credit to get by. The average interest rate on a credit card is now at multi-decade highs, near 20%, which adds further strain for those carrying balances. In this climate, more people are focusing on paying down debt and trimming non-essential spending to shore up their finances. Financial advisors note that consumers have become more value-conscious, seeking discounts and postponing big purchases amid uncertainty. Overall, household balance sheets are still supported by a strong labor market, unemployment remains low, but the mood is cautious, as many Americans feel less confident about their economic future unless inflation subsides. One indicator of consumer wariness is the sharp drop in sentiment. The University of Michigan's Consumer Sentiment Index has plunged to historically low levels, as detailed earlier, reflecting widespread anxiety over the economic outlook. This gloom mirrors what occurred in 2022 when inflation last hit multi-decade highs. Many consumers worry that their wages are not keeping up with the rising cost of living. Real income growth for median households has been sluggish, meaning paychecks don't stretch as far as they used to. On the positive side, the robust job market and residual savings from earlier stimulus measures have so far prevented a collapse in consumption. Retail sales have continued to grow modestly, though much of that growth is driven by higher prices rather than increased volume. Savings rates have declined from pandemic highs, however, and some economists caution that if inflation stays elevated, households could exhaust their buffers, leading to slower consumption later in the year. The state of consumer finances has thus become a pivotal factor in forecasts for the broader economy. Despite these pressures, certain segments of consumer finance have seen beneficial shifts. The housing market, for example, has cooled but not crashed. Some would-be buyers have been held back by 7% mortgage rates, but existing homeowners often refinanced at lower rates earlier and thus enjoy manageable payments. At the same time, rising interest rates mean savers are finally earning more on deposit accounts and bonds, offering a modest offset to inflation for those who can save. Auto lending and credit cards have become more expensive, but banks report that overall delinquency rates, while up slightly, are not yet alarming by historical standards. In essence, U.S. consumers are experiencing a financial squeeze, yet they are adapting by adjusting spending habits and benefiting from the strong labor market. How long this delicate balancing act can continue is uncertain. A lot depends on whether inflation recedes enough to ease the pressure on household budgets before savings run out or credit stresses mount. For now, households appear to be coping and hoping that relief from high prices is on the horizon. Video description. Today's finance news video covers the top 10 financial stories, including record-breaking stock market rallies, central bank policy decisions, emerging risks in banking, soaring commodity prices, breakthrough fintech innovations, strong corporate earnings results, cryptocurrency market updates, key developments in global finance, and the latest on consumer financial health. Each topic is presented with in-depth analysis, context, and implications in a balanced news reporting style, with no advice given. Viewers will get a comprehensive daily update on markets, macroeconomics, policy, banking, fintech, corporate earnings, commodities, crypto, global finance, and consumer finance, all the important financial headlines of the day in one detailed report. Tags: Finance news, stock market, global markets, economy, macroeconomics, central banks, monetary policy, Federal Reserve, interest rates, banking industry, fintech, technology, corporate earnings, oil prices, gold, commodities, cryptocurrency, Bitcoin, crypto regulation, global economy, consumer spending, inflation, market update, financial news today. Thumbnail, base concept. A bold, dynamic thumbnail visual that encapsulates the day's financial highlights, for example, A composite image featuring a rising stock chart over a globe, with icons of a dollar sign, an oil rig, a gold bar, and a Bitcoin symbol arranged around it. The words, "Today's Finance News," or "Financial News Today," appear in large, clear text, ensuring viewers immediately recognize the video's context. Thumbnail Variation A. A split-screen design, left half showing a stock market bull statue with upward trending green arrows and stock tickers to signify markets rallying, and right half showing an oil pump jack silhouette against a rising sun and a stack of gold bars, symbolizing surging commodities. Bold text overlay in the center reads, "Finance News Today," with a subheading like, "Stocks Rally and Oil Near $100." Thumbnail Variation B. A thematic collage, globe and currency imagery at the center, world map overlaid with a dollar bill design, surrounded by smaller vignettes, a Federal Reserve building, signifying central bank policy, a tech/AI icon, representing fintech and AI innovation, and a Bitcoin logo, for crypto news. A clear banner text at the bottom says, "Today's Financial Headlines," in depth, for immediate viewer clarity.